Today, as you know, the board decided to raise the cash rate by 25 basis points to 4.1%. The data we've seen since the February meeting has shown that the economy grew faster than its potential growth rate over the second half of last year. The labour market has tightened a little recently rather than being stable as we'd expected, and underlying inflation remains high. Taken together, the data suggests there is slightly more excess demand in the economy than we thought in February, and inflationary pressures are therefore somewhat greater. This is before considering what higher energy prices arising from the conflict in the Middle East could mean for our economy. Higher petrol prices will add to inflation, but they're not the reason for today's decision. Inflation was already too high, reflecting the fact that demand is outstripping supply. Higher fuel costs will not slow demand enough on their own to address this. If we do not act, these price pressures will spread and the eventual adjustment would be harder. This all suggests that the risks to inflation have tilted to the upside. We must also ensure that higher inflation does not result in inflation expectations drifting up. Short-term expectations for inflation have moved up a bit, but we need to ensure that this does not translate into higher inflation expectations over the longer term. Longer-run inflation expectations will only remain anchored if people are convinced that we will take action to bring inflation back to target. The board concluded that the cash rate was not at a level consistent with returning inflation to target within a reasonable time frame. If the Middle East conflicts get worse or are not resolved soon, higher fuel costs will push inflation here even higher. There's also a risk that global growth slows, which could flow on to lower growth here. But even abstracting from the global environment, domestic inflation remains too high and high inflation hurts all Australians.